Originally, I had a different video planned for you, but then Warren Buffett added a 4 billion position in Chevron in their latest 13-year filing. So I have to talk about it. So let's talk about this position objectively, look at the rest of the 13-year filing, and I want to share my thoughts on it. Don't worry, I will be talking about Australian company earnings very soon. As usual, this video is not financial advice or recommendation for you to do anything. It's just general information for entertainment purposes. So without further ado, let's go! I've broken this video into two main parts. First, I'll go over Berkshire's move into Chevron, then I'll go through the rest of the change in their 13-year filings. So it's obvious to point out why Chevron is a no-go for a lot of different investors, including myself.
And it's unlikely they'll ever consider it.
But I'm going to put my values aside for just a second and consider the other side of the argument why Chevron could generate massive shareholder value, at least in the near term. Now, as of recording this video, Chevron is trading at $93 per share at $179 billion of market capitalization. It hasn't been easy for oil producers, especially with the pandemic last year, not to mention the oil price war between Russia and also Saudi Arabia. And the post-pandemic EV craze did not help the share price of Chevron as well. So while WTI crude oil literally went to hell and came back to $60, Chevron didn't rebound like the oil prices. This is possibly because of the changing sentiment of both retail and institutional investors with a heavier focus on climate change. And that, in my opinion, has put a downward pressure on the share price of Chevron. At the same time, it's really easy to say that battery technology and electric vehicle are the future of our world. And I personally strongly believe that is indeed our future. But regardless of what I want and what I believe, that is not how the world works. It's incredibly difficult to suddenly go all electric. There are still problems we need to solve with renewable energy. For example, solar is unreliable in areas where there is inconsistent sunlight. Wind turbines might be frozen in colder climates. So until we can solve those inefficiencies, there are still value for both oil and gas. As painful as that for me to say. And then there is the fact that our transport infrastructure is powered by oil, especially our cargo ships. And even though I don't like the topic of talking about defense assets, they are also powered by oil. Okay, what I'm trying to say here is that while our world is moving towards renewable energy, the argument for fossil fuel companies is a transition asset to renewables. Because of the negative investor sentiment, crazy optimism around the tech sector, and a rebounding oil price, Chevron might just be considered as a heavily undervalued play for Berkshire to go hard in. I'm not sure whether Berkshire will ever explain the bull thesis, but if you have a bull thesis yourself on Chevron, let me know in the comment section below. But my personal question is, are they undervalued or is this a value trap? So let's take a look at Chevron's numbers. I've extracted 10 years worth of financial data. I've cleaned it up a little bit just so that there's only the important information. So revenue growth, gross margins, operating margins, basic and diluted EPS, and also EBITDA and EBIT. Now, of course, in your own research process, you can include more information, but I just wanted to point out a few things here. Now, in terms of Chevron's revenue numbers, you can see here that it's been really turbulent, especially on a decline. And a major contributing factor is that the crude oil prices has been also really turbulent. Now, if we pull up the crude oil WTI futures graph, you can see that since this period, oil prices have basically plummeted and only recently started to recover. Even though over the years they have improved their gross margins, Chevron is very, very dependent on commodity prices, and that is pretty much reflected in their operating margins. Now, I personally like to visualize a few of the key metrics just so that I can see what's happening to their numbers visually. Now, as you can see, the blue line is their revenue numbers, the red line is their operating margin, and the green line is EBITDA. And these curves look incredibly similar to the turbulent oil prices as well. Next, let's take a look at the cash flows before I talk about the balance sheet. Again, because Chevron is so dependent on oil prices, if we take a look at their operating cash flow, this decline looks very similar to the oil prices graph. And only recently, oil prices have rebounded, and I believe that we will see more of that rebound in the next quarter's earnings. Now, the bigger challenge for me is that Chevron is a dividend aristocrat, which means that for 25 years plus, they have not cut their dividends once. And we can see here that in their cash flow statement, the dividends paid, excluding special dividends, have been on a slight uptrend over the years. And the question for me is that what are they funding those dividends with? Because with their operating cash flow, it barely pays for the dividends. So it turns out that they are borrowing money in order to pay for those dividends with long-term debt issued. Personally speaking, oil companies are already a no-go for me, but seeing a company fund the dividend payouts with debt, that's an even bigger turnoff for me. But putting things in context, if we look at their balance sheet, their debt to equity ratio is 0.26, which means that for every $1 of equity, there are only 26 cents of debt. That is honestly not a lot of debt, and they have $6 billion worth of cash on their balance sheet. Now, if we zoom out a little bit, the short-term assets cover the short-term liabilities. So overall, I would say that their balance sheet is actually pretty strong. I'm not surprised Berkshire have pulled these moves. Warren Buffett is an investor that can identify value when it's really hard for others to do so. And it's true that while we transition to renewables, fossil fuels will act as a transition asset. Together with a rebounding in oil prices, I can understand the perspective that over the next 2 to 3 years, fossil fuel companies like Chevron will generate a lot of shareholder value. But the fundamentals, my value system, and my investment strategy is just not aligned with Chevron. So what do you think? What am I missing here that makes someone like Warren Buffett incredibly bullish on Chevron? Now let's take a look at what else changed in their 13F filing. Now let's go through the 100% stuff first. The 100% just means that they have completely exited their position. So they have completely exited gold, and it's not the commodity gold, it's Barrick Gold, which is essentially a miner or gold producer. And they have also exited Pfizer, MT Bank Corp, PNC Financial Services, and is that JP Morgan? Okay, interesting. So they have also exited their JP Morgan position as well. And it seems like they have also trimmed a big portion of their Wells Fargo position as well. You can see here this minus 58%. And I wonder if the investment team over at Berkshire are taking more of a bearish stand when it comes to financial services. Is it because of the low interest rates, so therefore their earning ability is basically dropping? I'm not sure if they'll ever explain their thesis, but I personally will really want to know. It also seems like they have trimmed their Apple position by about 6%, and also their GM position by about 9%, and a few others as well. Now, Apple is one of the biggest positions in Berkshire, and it's totally understandable that they've trimmed about 6%, only because over the last year, Apple have grown so much when it comes to their share price, and some people are saying that it's overvalued at this point. Whatever you believe, it just seems like Berkshire is just trimming a little bit, and that 6% change is $117 billion back into Berkshire's war chest if they were to reallocate that money. On the buy side, Berkshire have also added a big position in Verizon, and this position is worth double the amount in Chevron. It's about $8 billion. And that's only 3% of Berkshire's portfolio. The interesting thing to me is that Verizon's gross margins is actually better than AT&T, but I'm really interested in AT&T because they have HBO Max, which can capitalize on the future of streaming. And at the same time, you can see that Berkshire have added quite a bit in Kruger, Merrick, and also Abbey. So Abbey and Merrick, these are pharmaceutical companies, and MMC is Marsh & McLennan. That's a finance company. That's interesting. And Bristol Myers. I'm not going to talk about the rest, but feel free to go through the rest of the buy-side additions in your own time. For me, it's always interesting to look at how other fund managers are allocating their capital. Sometimes it gives me hints and sometimes it gives me warnings. And I think it's just a really good thought exercise overall. So thank you for watching this video all the way to the end. If you want to support the channel, not to mention access to additional content pieces and be part of my fortnightly Q&A, consider supporting the channel via Patreon. Nevertheless, if you have learned something new, remember to gently smack the like button right there, subscribe to my channel so that when I release future videos, you be the first one to know. Until next time, my name is David. Otto will always do the honors, and see you very, very soon.